Hi friends, welcome to Adda 24/7. We are in the Sankalpa series for BFM and here we are covering important theory, objective questions and numericals. Today we will be covering the theory definitions. Last 2 days we are covering the definitions, but 3 days in fact. But these are important theory questions from your exam point of view. Definitions means not only definitions, we are covering the important theory behind those topics. Okay, so follow the series completely. Okay, from tomorrow we'll be covering the objectives and numericals on the same chapter. So presently we are in chapter number 7, risk in foreign trade, role of ECGC. Okay, so let's start. See, exchange risk. What is an exchange risk? Here, exchange means what? When will exchange come in picture? Exchange will come in picture whenever you have one commodity and it is exchanged against the other. Okay, suppose if I give you some dollars, okay, and I take some money from you, then it's an exchange. What is the sabji wala? Vegetable vendor. What is the sabji wala business? Sabji wala business is same as that of the forex business. No difference. Sabji wala gives you the sabji, you give him that rupees, right? Similarly in dollars also, somebody gives you the dollars, you give them the rupees, or you give them the dollars, they give you the rupees. It's that simple, isn't it? So exchange risk arises when you have two or more commodities. See here, it's called as commodities. Rupee is also commodity, dollar is also commodity, everything is commodity. Two or more commodities you have, which are to be exchanged with each other. That's why what happens? The rates are to be fixed. How do you decide on the rates, right? So that is decided by the market, buy and sell. Okay, demand and supply forces. So exchange risk means relates to adverse movement in the currencies. Here, typically we are talking in forex. So it will relate to forex. So commodities here means two commodities will be there. Roughly, let's say one is dollar and second is rupees. So these are the two commodities. Okay, so relates in adverse movement of the currencies. What do you mean by adverse movement? Now see here, I am talking of risk. Risk means it's adverse movement. For example, I'll give you a simple example. Suppose if I brought a dollar, okay, let's say I brought $1. Take one example only. I brought $1 for 80 rupees. This is what I have brought. And now this dollar rate goes to 85. So am I at risk? Just type yes or no in the comment section. I brought $1 at 80 and now I am having this rate as 85. So I brought it and kept it with me. Now the rate is 85. Am I at risk? No, I'm not at risk because the dollar is favorable to me. This is known as a favorable position. Favorable. So what is unfavorable then? I brought it at 80 and now the dollar goes to 75. Now that is unfavorable because I brought it at 80 and now it is at 75. So this is unfavorable risk. This is the risk. See here, that's why it said relates to adverse movement in the currencies. If it's a favorable movement, then it's not a risk. Okay. Any exporter or importer faces exchange risk directly or indirectly. Obviously. What do you mean by this? Okay, I'll explain you. Okay. Any exporter or importer faces exchange risk. Means what? Exporter means what? What is the exporter? Exporter means that person who has sent the goods outside. Now that person will be getting the money. Okay. So if that person gets money and the dollar rate changes, then the amount of rupee which that person will be getting will also change. I'll explain this. See this. We are having this second slide. We are having this. I'll explain it over there. Okay. So invoicing in the currency other than home currency. This is also a typical exchange risk. Suppose if I am in India and I invoice somebody in rupees. Invoicing means what? Giving the bill. Invoice means bill. I'm giving the bill typically in rupees to this any person. So what will that be? That is no risk at all. Suppose if I am giving an invoice, I am giving you a bill tomorrow, let's say. You pay me 100 rupees, let's say, and I give you some service. So that 100 rupees, whether the dollar will rise or fall, this 100 rupees will be 100 rupees, right? Directly. So invoicing in other currency, if I give you the bill of $100 and then what happens? The dollar rate changes. Then I'm at risk. Why? Because I have to convert ultimately the dollar into rupees because I have to deal in rupees over here. So invoicing in the currency other than home currency is also related to the exchange risk. Other than home currency, okay? Got it clear? Strengthening and weakening of a currency in which imports are built. Now look at this. This is typical question over here. Strengthening or weakening. I told you I'll be explaining you this effect of currency. See this. Look at this. Weakening of a currency, good for the exporters, indirect rate. Now what do you mean by all this? If this sentence you understand, you will understand many concepts automatically. What is direct rate firstly? What is direct rate? Direct rate means $1 equals to rupees 80. This is direct rate. What is indirect rate then? Indirect rate is given in terms of GBP. 1 GBP equals to $1.5. Here dollar is fluctuating in indirect, and in direct this is direct. In India we follow the direct rate system, and in this GBP they follow indirect rate system. Okay. Now the days are not far off when we Indians will go for indirect rate system, because dollar is falling down. It will fall down in some years to come. So weakening of currency, good for exporters. Now what do you mean by this? Let's forget this indirect rate for time being. Let's focus on this only. Weakening of currency means what? $1, if I have to buy $1, I have to give 80 rupees. Now weakening of currency means weakening of rupee means what? So $1 will be costing weakening of rupee. Now rupee is weakened, so it will be rupees, let's say 90. For buying 1 kg of potato, I had to pay, let's say, 80 rupees. Now for purchasing that same 1 kg of potato, I am paying 90 rupees. So what has happened? This potato has become expensive. It has become stronger, expensive, right? That's why I have to pay more amount. Similarly over here, the $1 for buying $1, I have to pay 80 rupees. Now for buying that same dollar, I have to pay 90 rupees. So dollar has increased or strengthened. So this has strengthened over here, strength. And importantly, this 90 means this has weakened. This is weak now. So now look at this. Weakening of a currency is good for the exporters. Why? Why is it good for the exporters? Let's say I'll give you a simple example. Okay, let me remove this indirect rate now, because that is not needed for you. Let me remove this, okay, over here. Okay, so now, suppose if I bill you, let's say, I send you some, let's say 100 chairs or 1000 chairs to you in USA. Okay, and now what happens? I bill you, let's say $1,000. So you will give me, you as a buyer will give me $1,000, right? What will I do as an Indian person? I have to stay in India, so I need rupees. So I'll convert this. So 1000 into 80, how much will I get? 80,000. I'll be getting 80,000 rupees. Now what happens? Rupee weakens. So again, you will be paying me $1,000 only. So what will happen? How much will I get? I'll be getting 90,000 rupees. So if I sell it in the market and then convert this dollar to rupees, I'll be getting 90,000. Earlier I was getting 80,000. So it is good for the exporters. Always weakening of a currency is always good for the exporters. Always. And vice versa, reverse thing. Suppose let's say this same thing happens and I am the importer. Here, this was for exporter, typical. Okay, exporter. Okay. Now let's consider the same case, reverse case. I am buying something from you. Okay, and you are charging me $1,000. Okay, for those $1,000, I have to give you 1,000 now, because I am buying goods. I am the importer. So in importer, what happens? Earlier I used to pay 80,000 rupees for buying this $1,000, but now the rupee has weakened. So I'll be paying 90,000 rupees for buying the same 1,000. So I'm paying more. So it is bad for the importers. Bad. Okay, for importers. Always remember, it is bad for the importers. Got it? Typical. So this is the basic logic behind weakening of currency and strengthening of currency. Weakening of currency is always good for the exporters, and strengthening of currency is always bad for the exporters. Okay. So this case, see this is weakening. So it is good for the exporters and bad for the importers. Clear? Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates explained on JIB and CIB from IIBF, because IIBF gives you various notifications. Okay, so these notifications are explained to you, not only given but explained also, because they are difficult to understand. Many a time many of the bankers don't understand what is it trying to say. So one, you get latest updates, very important part, updates. And second thing, what do you get? Updates. And second thing, you get free YT series, free YouTube series. Right now, what are you watching? You are watching the free YouTube series. Similar YouTube series, you get it for this ABM, this BFM, ABFM, BRBL, all the 4 subjects. Okay, so that's why subscribe to the channel immediately, Officers Adda 24/7. Click on the bell icon, click on the like button. Okay, then share it with your friends. Okay, policies of ECGC. Remember, here ECGC, this chapter typically is related to risk as well as ECGC. What is ECGC? Export Credit Guarantee Corporation. Now remember, I'll give you one typical point about this here. Now it is called as ECGC Limited. ECGC Limited it is called as. Now, if I ask you really in legal way that ECGC, if I ask you what do you mean by ECGC Limited? So you shouldn't say it is Export Credit Guarantee Corporation Limited. No, it is only ECGC Limited. They have removed this full form. So ECGC Limited is ECGC Limited. It was called, formerly it was called as Export Credit Guarantee Corporation. Now it is a separate company. Okay. So, but it does the same job. Okay. It gives the insurance. What does it do? Export Credit Guarantee Corporation. Export Credit. So typically okay, I'll write the full form also. Export Credit Guarantee Corporation. Okay, that is ECGC. Okay, actually see this is full form is the earlier it was called as Export Credit Guarantee. Now it is called as ECGC Limited only. So what does it do? It does credit insurance. Here there are 2 policies or 2 things which are given by ECGC. Typical. One is policies and second is guarantees. See, both the things are given. Policies are given for the exporters. Let me see here. Now you know the name. Shall I remove it? Everyone type yes in the comment section if I remove this ECGC Export Credit Guarantee Corporation name. Remove it. Okay. Yes. Okay. I'll remove it. See this. So here it gives, ECGC gives basically 2 types of policies, you can say. One is for the bank, ECGC. One is for the exporter and second is for the bank. Okay, bank. Now for the exporter, it gives policies. See this, exporter, it gives policies. Always remember this. It gives policies for the exporters, and for the bank, it gives guarantees. Okay. It gives guarantees for this export banks. Okay. Now what are these? Understand, you firstly got this exporter, they give the policies, bank, they give the guarantees. That's it. Now we'll study what is policy and what is its guarantee. See this, policies for ECGC. A credit insurance policies are given to individual exporters to cover the risk of non-payment by the buyer of goods or other events. So typically, why does the buyer need an insurance? Why does the seller need an insurance? The seller needs it because if the seller sends the goods and the buyer doesn't pay, then what? You'll say then typical LC is there. But LC cost me higher than the ECGC policies. ECGC policies are always cheaper than the cost of the LC. This is, ECGC is always taken on collection basis or open account basis. There are 4 methods of payment. Who can tell me what are the 4 methods of payment in international trade? Always remember, tell me which are the 4 important methods of payment. One is, shall I write it? Okay. First is, let me see if I can write it over here. Hold on. One is advance payment. Advance payment. Okay. Advance payment. Second is open account. Open account. Now see this. These are typical terms and these are very difficult. It will take a lot of time to understand. I have explained this in my earlier lectures. Advance, open account. Then there is collections. Collections. And last one, it is LC. So these are the four methods of payment. So ECGC is generally applicable to these collections and open accounts. Typically. Okay. Because in both these things, the seller is at risk. Advance payment, buyer is at risk. LC, bank is at risk. Okay. So policies of ECGC. So credit insurance policies are given to individual exporters to cover the risk of non-payment by the buyer of the goods or other events. Other events means anything can happen in this world. Political instability, like what happened in this Afghanistan. Taliban took over. Suppose if you have sent some goods to Afghanistan, then the payment won't be received because Taliban had stopped the forex currency movement from the country for some time. So that is known as policies, means exporter's risk. So exporter is always given the policy. What about the guarantees? See this, insurance cover or guarantees of ECGC. So guarantees are given to the financing bank to cover the risk of non-payment by the exporter or the drawee of the export bills. Okay, financed by them. What do you mean by this? Okay, let me remove all these things. Now you have already know this. So now insurance here. What happens if the bank says, if bank gives me here, let me explain you this. Suppose let's say I am the exporter. Okay, I am the exporter. E over here, exporter. Okay, I have sent the goods. Goods are sent out. Goods. So I'll be receiving the payment. But for manufacturing these goods, I need some loan. So bank gives me the loan. So bank gives me which type of loan? Bank gives me pre-shipment or post-shipment, both, right? Pre or post. Okay. And then what do I do? With pre-shipment, I manufacture the goods, then I send it, and then I take the post-shipment. And then I convert this post to pre to post. Okay. Now the typical problem over here is, if I as an exporter don't get the money for these goods, this buyer in USA, UK, wherever the buyer might be, the buyer does not pay me. So what will happen? Even I can't pay to the bank. So what happens? This loan becomes NPA. So now to cover this NPA, to cover this relationship between bank and the exporter, here in guarantee part, it has nothing to do with this importer part over here. It is only concerned with the bank and the exporter relationship. So this insurance cover are given to the financing banks to cover the risk of non-payment by the exporter. Non-payment. So if I don't pay as an exporter, then bank will be at loss. So bank gives a typical insurance, gets a typical insurance on this part. And this is known as guarantee from ECGC. If any of the exporter does not pay to the bank, in that case, bank will get the money from this ECGC. This NPA can be removed or reduced by using the ECGC policies. Okay. Yeah. See here, it's typical. See, if the exporter does not get the money from the buyer, the exporter won't be able to pay to the bank, right? Pre-post cannot be closed. So that is a typical thing. Okay. Shipping risk. This includes risk arising due to other intermediaries. Means what? Other intermediaries. What do you mean by this? Other intermediaries means here there are two parts, basically two parties in any business. One is buyer and second is seller. So seller sends the goods to the buyer, right? And then buyer gives the payment. Now what is shipping risk? See here, seller will send the goods through what? The seller will send the goods either through ship or through road, means truck, anything. Then trains, airplane, air, right? Any of these. So any of these, the goods can be mishandled in this, right? The goods can be broken. See here, arising due to other intermediaries in the international trade like shipping companies, handling agents, port authorities, local transporters, and even loaders. Loaders mean those who load the goods, which may lead to delays, non-shipment of good in time due to variety of reasons like goods being mishandled, broken, goods abandoned. Abandoned means kept aside and then forgot. Everyone forgot about those goods. Abandoned. Goods siphoned off, robbed. Siphoning means robbing. Theft, burglary. Goods wrongly delivered means they were to deliver to A. Now they have been delivered to B. Someone else only. So this is known as wrongly delivered. Goods delivered at another destination. Again, it means wrongly delivered. Okay. Another destination typically means what? Say, it means that suppose if I told you, suppose if I am the importer, I have told you that what you do, you send the goods to my Mumbai office. Okay. And you are the exporter. What do? You send it to my Chennai office. Now, bringing the goods from Chennai to Mumbai is not a small task because you know the distance. So, this is delivered to a wrong destination. So, that is basically shipping risk. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. What all do we need for clearing CAIIB? We need classes, we need books, we need tests. All the three are available. So, that's why download it right now. Okay. What is maturity factoring? This is a typical topic. Tomorrow I'll be taking this. Okay. Factoring, I'll be dealing with this because this is a bit difficult topic. I'll be dealing tomorrow in factoring and forfeiting. Okay. A guarantee scheme under which the factor pays only on the due date of the export receivable and not at the time of drawing of the export bill. Okay. So the factor pays, see this, factor pays only on the due date. Factor means what? This is typically the bank. Typically the bank pays only on the due date of the export receivable and not at the time of drawing the export bill. Drawing means drawing the export bill. It means whenever the bill is drawn, written. The financing of the bill is done by another financer on its strength. Okay. So maturity factoring is different. See here, maturity factoring means this is a typical case of factoring. Factoring means what? Simply factoring means financing this customer. Open account. Generally, factoring is done on open account basis. So, financing this customer immediately means it is financed immediately. When the bill is drawn, at that time only it is financed. And maturity factoring is typical part of factoring in which the factor pays only on the due date of the export receivable. Remember, this maturity factoring name itself means payment on the due date. This is a typical exam question. I'll be explaining factoring tomorrow. Okay. Everyone join the Sankalp batch starting from September 4th. All the numericals, objective questions, case studies, everything is covered. You can join the Mahapack also. In Mahapack 2.0, you will get the live classes, video courses, ebooks, tests, mini and Maha marathons, practice papers, doubt sessions, everything. And now this is available at 80% off right now. 80% huge discount is going on. Okay, use the code MOON80. I'll give you. Okay, MOON80. Moon means why moon? Moon, we landed on the moon, right? So that's why this 80% off is going on. Let me show you. Go to Adda 24/7. I would always suggest you to go through the app. In the app, you are getting coin systems. Coins means what? You go on buying it through Adda 24/7 and the coins get collected. Now this coin system will help you around 1% extra. So that's why let's go to Adda 24/7. Look at this. Okay. Now you are on Adda 24/7. Here you go to click on this JIB and CIB. Then click on this CIB November. Okay, click. You'll see the batches. See this. Click on this English Sankalpa batch. Okay, click on this batch. Done. And see this 300 hours of online live classes, 78 test series, 65 ebooks. See this, click on this, any of these test series, you'll get the details. How many test series are there? Look at this, module wise, chapter wise, topic wise, test series are there. Ebooks, all the 4 ebooks are available, all the 4 compulsory subjects. Online live classes, check these. That's why I'm saying go through it. Even if you click on these, let's say I'll click on this test series, see the 7 mock tests. Again, you see the mock tests. Typical chapter wise, module C, 13th, 11th, 12th. So all these mock tests you are seeing. So that's why I would say join this SAP. Okay, click on this buy now. Once you click on the buy now, see this 80% off is already applied. Click on this, then click on continue. A full name, phone number, email, just do it, continue, make the payment. What is the payment? See this 23,999 reduces to 4,799. Huge discount offer. Similarly, Mahapack also. You can join the Mahapack. In Mahapack, you are getting multiple batches. Okay. Look at this. JIB and CIB again. Go to JIB, CIB, Mahapack. See this. Click on CIB Mahapack. Okay. Double validity is there right now. Online live classes, test series, ebooks, videos. Click on these. Again, you will go through it. Recorded videos are available. Click on buy now. Look at this. 6 plus 6 double validity. 12 months validity. Plus, what is the fees? 80% off. 36,837 reduces to 7,367. Isn't it a huge offer? Double the markup. Join it ASAP because the exams are when? Just now in November. Not many days are left. Join fast. I'll be back tomorrow with another series. Till then, keep studying and join the batches. Bye.